Good evening, class. I'm with the Group F team here to tell you all about behavioral finance. Just a little breakdown of the team here. My name is Davey Zong, and I'm joined here tonight with Jason Vance, Rohan Patel, Jason Adelaide, Adam Murad, and Christopher DeFilippi. And today we're going to discuss what is behavioral finance. And here are some of the main goals we have here for today. And this is an overview of the topics we are going to be covering. Now that we have an overview, let's dive into the two key perspectives in finance: traditional finance and behavioral finance. So traditional finance assumes that investors are rational, markets efficient, and that risk and return are the main drivers of financial decision making. Behavioral finance, on the other hand, challenges these assumptions by considering psychological factors and biases that influence investor decisions. So first, we'll explore the three foundational principles of traditional finance. The first one being the efficient market hypothesis. So the EMH suggests that stock prices reflect all available information, making it possible to consistently outperform the market. There are three levels. The weak form says that prices include all currently available market data, meaning that technical analysis would never work because it relies on history repeating itself. Semi-strong says that a price of a stock is adjusted based on new information, so fundamental analysis can't be used. And lastly, the strong form efficiency says that prices include all public and private trading information. Next, we have the expected utility theory, and traditional finance also assumes that investors make decisions based on rational utility maximization. So this theory states that people make choices to maximize their expected utility, not necessarily their expected monetary value. So some of the key principles are risk aversion, which are investors prefer a guaranteed outcome over a risky bet with the same expected value. So for example, a person prefers $500 guaranteed over a 50% chance of winning $1,000, even though both have the same expected value of $500. So consistency states that preferences should be stable. If an investor prefers stock A over stock B today, they should continue preferring stock A over stock B tomorrow unless new information arises. So another assumption in traditional finance is that investors behave rationally and markets are efficient. So investors are rational. They process all available information correctly and make logical investment choices. Markets are efficient. Prices adjust instantly to new information, eliminating opportunities for mispricing and risk-return trade-offs. So investors accept higher risk for the potential of higher returns. However, real-world market behavior often contradicts these assumptions, leading to the rise of behavioral finance. But if markets are efficient and investors are rational, why do we see market crashes, bubbles, and anomalies? This is where behavioral finance comes in. So traditional finance assumes rational behavior, but human emotions often lead to irrational decisions. So behavioral finance suggests that psychological biases and cognitive errors drive investor decisions. So, for example, the 2008 financial crisis. According to traditional finance, the housing market should have adjusted efficiently. Instead, risky mortgage-backed securities were overvalued, leading to a market collapse. So one of the most well-known behavioral finance theories is prospect theory. Unlike expected utility theory, prospect theory suggests that people perceive gains and losses differently. So investors feel the pain of an $100 loss about 2.5 times stronger than the pleasure of an $100 gain. And risk asymmetry states that investors take on more risk to avoid losses but are more conservative with gains. For example, an investor is offered with two options. Let's say a guaranteed gain of $500 and a 50% chance to gain $1,000 and a 50% chance to gain nothing. So most investors take the guaranteed $500 over a 50% chance to gain $1,000 and 50% chance to gain nothing, even though they have, the same expected value. So next we have market efficiencies and anomalies. So because investors don't always act rationally, we see market anomalies that contradict the efficient market hypothesis, such as the dot-com bubble, in which tech stocks surged a great amount and then crashed, and the housing bubble with overconfidence in mortgages, leading to a 40% market decline in the S&P 500. There's also momentum effects, stating that stocks that have performed well continue rising, contradicting EMH, and value and growth anomalies. So a key takeaway of this is that behavioral biases drive pricing inefficiencies, allowing some investors to generate excess returns. And finally, investor psychology impacts market pricing and behavior in several ways. So, investors are actually irrational. So, cognitive biases and emotional decision making distort prices, and some investors hesitate to short sell even when they believe a stock is overvalued, contributing to mispricings. Additionally, markets do not always immediately adjust to news. Investors may panic or ignore information, causing inefficiencies. So, where traditional finance assumes rationality, behavioral finance recognizes biases. So, next we'll dive deeper into heuristics and biases and their impact on investor decision making.
Next, I will cover the common heuristics and behavioral biases which influence and control financial decision making, whether it be subconsciously or active thinking. Many investment decisions are based on perceived pattern identification in random and uncertain events. Investors often look for patterns where none exist, leading to overconfidence in market predictions. This tendency is known as apophenia, a cognitive bias associating the human inclination to see meaningful connections in random data. People also have difficulty assessing conditional and joint probabilities. Investors often struggle with understanding the likelihood of multiple events occurring together. This leads to the mispricing of risk, overestimating rare events, and poor portfolio diversification. An example of this is an individual misinterpreting how one economic event influences another, leading to flawed investment strategies. Rather than using statistical reasoning, people rely on mental shortcuts, and those would be the commonly seen behavioral biases. These heuristics simplify decision making but often result in systematic errors. And I'll go over some of the most common heuristics and biases practiced in regular finance in the coming slides, as it's important to note how these biases distort risk perception, leading to poor financial decision making. So, what is a heuristic? By definition, it is the general rule of thumb which is commonly practiced in investment decisions. More simply, it is a neurological shortcut which has been developed through both time passing and cultural influences. Some of the most commonly utilized ones include the availability heuristic, which is the tendency to overestimate the likelihood of events that are more readily available in memory. For example, people may overestimate the risk of dying in a plane crash because they can easily recall stories about plane crashes. The anchoring bias is the tendency to rely too heavily on the first piece of information offered, aka the anchor, when making your decisions. For example, people may be more likely to pay a higher price for a house if the initial asking price was high, even if the house is not worth much. Finally, the representative bias, the tendency to judge the probability of an event based on how representative it is of a category. And we will take a deeper look into that in the next slide. So, a few examples of representativeness in gambling practice and how we could see it influence investor decision making. Those include the hot hand and gambler's fallacy. The hot hand belief follows the past as a trend setter and expects future events to continue in that trend, while the gambler's fallacy sees the past and expects it to revert. For example, people may think that a coin is more likely to land on heads after it has landed on tails several times in a row. A sequence such as heads, tails, heads, tails, heads, tails is expected to be more likely than a sequence such as heads, 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 tails, 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 which isn't perceived as random, or a sequence such as heads, 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 tails, which isn't representative of the fairness to the coin. Some other less frequent but notable cognitive biases include loss aversion. Basically, a dollar loss hurts more than the happiness derived from gaining a dollar, although this does not make much economic sense since the net wealth change is still zero. Risk aversion, in regard to risk aversion, investors are typically more averse in the gains domain, yet risk-seeking in the losses. This has to do with behavioral tendencies to prefer uncertain losses to certain losses and certain gains to uncertain gains. And this can be seen in the prospect theory value function or the S-shaped value function. As this graph indicates, the value placed on the $100 loss is significantly greater than the value placed on a $100 gain, despite the economic weight being equal. Overconfidence. People generally overestimate their own abilities. For example, if you ask most people if they believe they are an above-average driver, 88% of people will say they are, which is obviously statistically impossible. Overconfidence is most likely to occur in financial decision-making when the task ahead is perceived as difficult. This is according to Baruch Fishkoff's publication of his journal, Experimental Psychology, The Appropriateness of Extreme Confidence in 1977. but it's also been studied by psychologists Lichtenstein and Yates, respectively. A common reason for overconfidence in finance is excessive trading, touting people, the belief that they hold expertise, which is simply not the case. And this is a combination with under diversification often leads to stagnant portfolios and the false belief that they have an informational advantage. Familiarity bias, which has to do with the comfort by name association. It is seeing an investment decision as risk averse due to the knowledge of its existence. And finally, narrow framing, which is the tendency to focus entirely on the direction of a singular investment instead of the aggregate portfolio's position.
Next, we'll be discussing how cognitive biases impact investment decisions and influence both investors and analysts. While we like to think that financial decisions are made rationally, research shows that people are often acting irrationally due to psychological biases. Investors aim to make rational choices, but in reality, their decisions are often influenced by psychological and emotional factors rather than pure logic. And studies in behavioral finance have proven that people do not always function as economically rational agents, but instead they are affected by their own mental shortcuts. Several factors contribute to these biases, including limited brain capacity, emotions, and other human constraints. But no matter how much information is available, investors sometimes make decisions based on flawed reasoning. In financial settings, beliefs can be distorted by irrational and incorrect assumptions, meaning that investors and analysts might hold on to losing stocks for too long, trade too infrequently, or follow the crowd instead of making independent decisions. Cognitive biases serve as mental shortcuts to simplify decision making, and they often lead to poor investment decisions, excessive risk taking, and missed opportunities. Next, we're going to dive deeper into each of these biases. The disposition effect describes how investors tend to sell stocks that have increased in value too quickly while holding on to losing stocks for too long. This is often driven by loss aversion, regret avoidance, and overconfidence in the stock rebounding. Now, why does this happen? Well, investors fear regret and avoid selling losers. There's a belief that prices will return to historical averages, leading to delays in selling losers. Some investors gamble, hoping for extreme payoffs. Others hold on to losers, preventing self-feedback to be negative. Investors may also attribute negative returns to randomness instead of acknowledging poor investment decision. In a real-world example, we saw during the 2008 financial crisis, many investors refused to sell plummeting real estate and bank stocks, believing they would recover. A notable case was Lehman Brothers. Despite a steep decline, many held on, hoping for a rebound, only to lose nearly their entire investment when the firm went bankrupt. Conversely, some investors hold safer assets, such as treasury bonds, too early, missing out on further gains. Overconfidence leads investors to trade excessively, believing they possess superior knowledge and skill. It is especially common when forecasting is difficult, events are unpredictable, and there's no immediate feedback. This impacts investors by leading to excessive trading, overall reducing net returns, encourages underdiversification when investors concentrating portfolios in a few stocks, believing that it will have an informational edge, can contribute to bubbles and market crashes, and often fueled by self-attribution biases where investors credit success to skill but blame failure on external factors. Another real-world example would be the dot-com bubble. Investors were overly confident in the growth of internet-based companies. Many investors ignored traditional valuation metrics and poured money into firms with little or no profit. Beyond the disposition effect and overconfidence, there are several other cognitive biases that impact financial decisions, such as confirmation bias, where investors seek information that aligns with their beliefs and ignore contradictory evidence. Herd mentality, where investors follow the crowd rather than making independent decisions, leading to bubbles and crashes. Recency biases, where investors assume recent trends will continue indefinitely. And naive diversification. Investors split their money evenly across investments instead of strategically selecting the best options. Analysts play a crucial role in financial markets by forecasting earnings, predicting stock prices, and making buy-sell recommendations. Ideally, they are objective and data-driven, but the reality is they are influenced by the same psychological biases, incentives, and external pressures as investors. The main consequences of analyst biases are that they tend to overvalue stocks, which can contribute to market bubbles and crashes. In addition, analysts are slow to downgrade stocks despite clear warning signs, and momentum-driven ratings can cause price swings in the short term. Conflicts of interest is analysts that prioritize personal employer or client incentives over objective analysis. Investment banks often pressure analysts to issue positive ratings to attract business from corporate clients. Brokerage firms may encourage analysts to find favorable recommendations to drive trading activity. Hedge fund and asset managers may issue biased recommendations based on their firm's existing positions. Optimistic forecasts may be issued to maintain relationships with corporate executives and provide privileged information. These biases and conflicts of interest can distort financial markets, leading investors to make suboptimal decisions.
Hello everyone, my name is Christopher Luca Di Filippi, and I'm here to talk to you guys about behavioral asset pricing. More importantly, how behavioral factors influence the pricing of these assets. To get straight into it, traditional financial theories assume that investors are rational and the markets are truly efficient. But in reality, psychology plays a huge role in these market movements. Behavioral finance gives us a different perspective, showing us how emotions, biases, and institutional constraints lead to these market inefficiencies. We'll next break this down into three key factors: investor sentiment, limits to arbitrage, and bubbles and crashes. Understanding these key elements can help us make sense of why markets don't always behave the way we expect them to. Investor sentiment. One of the most important drivers of asset prices is investor sentiment. Essentially how optimistic or pessimistic investors feel about the market. Unlike fundamentals, which are based on company earnings or economic data, sentiment is often emotional and influenced by external factors like news, social media, and the general mood of the market. When optimism is high, investors tend to rush in, which then leads to overvaluation and excessive risk-taking. On the contrary, when fear takes over, people tend to panic and sell, often undervaluing these assets. You've probably heard of bulls and bears. Bulls tend to push prices up with optimism, while bears drive them down with pessimism. When too many investors follow the crowd, we then tend to see these extreme price movements that stray far from reality. A perfect example of this is the GameStop saga in 2021. Retail investors, driven by social media and the belief that they could challenge Wall Street, pushed GameStop's stock price up way beyond its fundamental value. Institutional investors who had shorted the stock were forced to buy back shares, causing an even bigger spike. This was a classic case of how sentiment, not fundamentals, can control the market. Limits to arbitrage. If markets were truly efficient, traders would quickly correct mispriced assets. But in reality, mispricing can persist for a long time due to limits to arbitrage, which are these barriers that prevent rational traders from fixing these market inefficiencies. For example, short selling constraints make it difficult to bet against overpriced stocks. Investors also face career risks. Fund managers don't want to risk going against market trends if it means underperforming in the short term. A historical case is the dot-com bubble, where tech stocks were massively overvalued, but rational traders couldn't easily short them due to these constraints. This allowed prices to stay inflated for years before the inevitable crash. This brings us to bubbles and crashes, some of the most dramatic effects of behavioral finance. Bubbles happen when speculative optimism pushes prices far beyond their real value. At some point, reality kicks in, panic spreads, and the bubble bursts, leading to a crash. The cycle typically follows these stages. First, in the stealth phase, early investors quietly accumulate assets. Then the awareness phase brings in more investors, increasing media coverage. The mania phase is where everyone jumps in, and the FOMO, fear of missing out, drives prices to unsustainable levels. Finally, in the blow-off phase, the crash happens as investors rush to sell. An example is the 2008 housing crash, and as well Bitcoin's boom and bust cycles, and even the dot-com bubble, as previously brought up, has followed this. All of these have followed this pattern. Models incorporating investor sentiment. Behavioral models help explain these market anomalies. The Investor Sentiment Index shows how speculative markets can detach from fundamentals. Shiller's CAPE ratio warned that stocks were overvalued before major crashes, as well as the noise trader model suggests that irrational traders move prices. If you think back to the GameStop case, it aligns perfectly with this model. Traders made decisions based on sentiment rather than logic, which caused prices to surge beyond reasonable levels. Another key concept is heterogeneous beliefs, meaning different investors interpret information differently, leading to price divergence. Markets aren't made up of identical rational traders, they're made up of people who have conflicting views on valuation. Models like the speculative asset pricing model and the overconfidence model explain how traders with different expectations and overconfidence in their knowledge can push prices away from fundamentals. We see this in debates over Tesla's valuation. Some believe it's worth far more than its earnings suggest, while others think it's in a bubble. These conflicting perspectives create market volatility and trading opportunities, truly.
I'll be covering psychology-based trading strategies, how emotions and biases influence market behavior. Traditional finance assumes rational investors, but real-world decisions are driven by psychology. Behavioral finance explains why investors don't always act logically. Today, I'll focus on 5 key biases that impact trading. The disposition effect, selling winners too early and holding losers too long. The herding effect, which is following the crowd, creating bubbles and crashes. Overconfidence and excessive trading, which is trading too much due to displaced confidence. Fourth, we have contrarian investing, which is going against the crowd to find mispriced assets. And momentum investing, betting that past price trends will continue. Let's start off with the disposition effect. The disposition effect happens when investors sell winners too early but refuse to sell losers, hoping to break even. A real-world impact is underperformance. Investors hold on to bad stocks and miss out on strong performers. For example, if an investor buys stock X at 100 and they sell at 120 to lock in gains, or they'll usually sell at 120 to lock in gains, but they'll hold it if it drops to $80, hoping for a rebound. Research shows this leads to 3.4% lower returns annually. The consequences: poor performance, missed opportunities, and emotional decision-making. Herding. Herding happens when investors follow the crowd rather than doing independent analysis, driving market bubbles and crashes. This leads to overinflated prices and panic-driven sell-offs when sentiment shifts. A classic example is the dot-com bubble of 1999 to 2000. Investors rushed into tech stocks with no profits, only for prices to crash when reality set in. The consequences: artificial price inflation, extreme volatility, and losses for latecomers. Next, we have overconfidence and excessive trading. Overconfident investors believe that they can beat the market, leading to excessive trading, higher fees, and worse returns. Frequent traders often underperform because they misjudge their ability and overlook costs. For example, investor B trades weekly thinking that he might have an edge, but they ignore the transaction fees and randomness, hurting their returns. Studies show overconfident traders underperform by 4% annually. The consequences: lower net returns, higher risk, and misplaced confidence in stock picking skills. Next up, we have contrarian investing. Contrarian investors buy when others panic and sell when others are greedy, going against the herd mentality. They look for undervalued opportunities in market downturns. A great example is March 2020, when the S&P 500 dropped by 35% in a month. Many sold in fear, but contrarian investors who bought saw 70+% gains in a year. The consequences: contrarian investing can lead to high returns, but it also requires patience and strong risk tolerance. Momentum investing. Momentum investors bet that past winners will keep rising and losers will keep falling, capitalizing on trends. Momentum strategies often outperform in the short term, but they're vulnerable to sudden reversals. A study by Jagadish and Titman in 1993 found that momentum stocks earned 6 to 8% annual excess returns, but in 2008 they crashed by 50+% when trends reversed. The consequences: momentum investing works in strong market trends, but crashes can wipe out gains. In summary, psychology drives investor behavior in ways that create inefficiencies. Understanding these biases help us make smarter trading decisions.
The next part of our presentation is going to talk about behavioral corporate finance. Behavioral corporate finance examines how biases influence managerial decisions. Unlike traditional finance, which assumes rational decision making, managers tend to exhibit cognitive biases that impact financial policies. The key question is, do corporate managers exploit investor irrationality, or are they simply affected by the same biases as retail investors? One way managers respond to investor sentiment is through market timing, issuing equity when stocks are overvalued and repurchasing shares when they're undervalued. When retail investors are overly optimistic, companies tend to issue more shares, but these firms often underperform later. Similarly, when pessimism causes stock prices to fall, firms may initiate buyback programs. This suggests that managers recognize and capitalize on market inefficiencies rather than making purely rational decisions. Managers don't just react to investor sentiment, they also cater to investor preferences. For example, when dividend-paying stocks are in high demand, firms may introduce or increase dividends, even if reinvesting those funds would generate higher returns. Likewise, companies may use stock splits to keep prices in a range that appeal to retail investors. While these actions boost short-term stock performance, they don't necessarily create long-term value and may reflect managerial optimism. Just like retail investors, corporate managers are also influenced by behavioral biases. Overconfidence leads to CEOs overinvesting and relying too much on internal financing, and loss aversion makes them reluctant to cut failing projects. Another example is anchoring and herd behavior, which causes firms to follow industry trends rather than independent analysis and can lead to widespread inefficiencies throughout the company. This is particularly evident in acquisitions, where executives often overpay for targets, expecting synergies that rarely materialize. A CEO's personality and decision-making style also can significantly impact corporate policies. Overconfident CEOs favor debt over equity, believing their stock is undervalued, while risk-taking CEOs can lead companies with higher leverage, and more conservative leaders make different financial decisions. For example, Steve Jobs took a bold innovation and risks at Apple, while Warren Buffett's strategy at Berkshire Hathaway has been far more cautious. These differences show how managerial styles can override firm fundamentals. Investor and managerial biases don't just affect firms, they shape the overall economy. Sentiment-driven decision-making influences GDP growth, financial stability, and unemployment rates. Mood and optimism can fuel booms, while fear and pessimism can deepen recessions. Even policymakers are subject to biases, which can lead to inefficient or delayed economic responses. Biases don't always cancel out. They often accumulate and reinforce economic cycles. When investors make similar mistakes at the same time, it can create market-wide inefficiencies. Research shows that investor sentiment correlates with regional GDP growth, employment rates, and financial stability. Policymaker biases, such as short-term thinking and overconfidence, can worsen downturns and lead to mismanagement of economic crises. Risk sharing is an essential function of financial markets, allowing individuals and businesses to manage income fluctuations and economic shocks more efficiently. Risk sharing mechanisms in financial markets are essential for economic stability, but their effectiveness depends on investor sophistication. Financially inviterate investors make better risk management decisions, leading to more stable income and reduced economic volatility. In contrast, low financial literacy is linked to excessive debt, weaker savings, and increased financial fragility. Expanding financial education and market access can help mitigate these risks. And to exemplify this concept, on the screen we have a graph that compares average risk sharing and a sophistication index. As we can see, there is a strong correlation between risk sharing and sophistication of market participants. Finally, we want to talk about the mood, optimism, and economic cycles. Psychological factors are also known to shape economic cycles, and optimism can drive excessive risk-taking, while widespread pessimism can slow recovery. Consumer confidence indexes track how sentiment influences spending and investment. A notable example is the 2008 financial crisis, where declining confidence prolonged economic contraction. Understanding these patterns helps policymakers and investors anticipate economic fluctuations and adjust strategy accordingly. Thank you very much, and we would like to open up for questions.